Welcome back. More now on Fed Day and what it may mean for the bond market. Jim Caron is the head of interest rate strategy for Morgan Stanley. He joins me now from his company's headquarters here in Manhattan. So, Jim, we're looking at the 10-year note yield at, what, a 6-month high. Are you still Treasury bear, given the fiscal stimulus we're probably going to see out of Washington?
Absolutely. Look, we're getting great fiscal stimulus, or so it seems. We've got monetary stimulus. The data is starting to improve. I'm looking forward to a reasonably strong 2011. We have a 4% GDP forecast, so we see yields moving higher. In fact, we see 10-year notes reaching all the way up to 4% next year. Really?
4% by what, end of 2011 for you?
By end of 2011.
Yeah, I guess the latest report I was looking at, you've upped it since then. You published December the 3rd. So since you've seen the news out of Washington, you've upped that.
Yeah, it was a new data point. We weren't counting on the fiscal stimulus of this magnitude, and quite frankly, it took us by surprise that we would have a tax package as aggressive as this. So what we had to do is revise all of our growth forecasts and also our yield forecasts as well.
So given that, is it appropriate for Bernanke to continue to go through with all $600 billion of quantitative easing?
I definitely think it is, because look, we've got to get inflation to a level that he's comfortable with, which I think is around 2%. I think we can get there, but I think what Bernanke's going to try to do is overshoot. And I think we need to get growth up to a level that he's very comfortable with as well. And again, I think it's a question of the overshoot. The last thing he wants to do is make the same mistake that was made in Japan, where they started to see some growth and improvement, back in the late 90s, and they tightened policy, and then suddenly they went into a longer, economic doldrums. And I think Bernanke's trying to avoid that mistake. So I think he's got the pedal to the metal, and he's going to keep the stimulus pumping.
Well, one of the things in the past year that sort of threw a monkey wrench into forecasts for U.S. debt was what was happening in Europe and the reverberations of the sovereign crisis there. In looking at your forecast, you're actually looking at possible infection of the core. You're hedging against Germany in 2011. Yeah,
that's exactly right. I mean, look, ultimately, we think that the problems in Europe will impact the core, and namely Germany. So we think that yields in Germany may actually start to rise. So as we look at 2011 and we try to hedge our risks, the number one risk that we're going to start to hedge is Germany. We're just concerned. The question for us is that it's just a matter of time before it does get to the core. Ultimately, we think that the ECB and Germany alike will have to bear the burden of most of this, and that's why we're most concerned about Germany.
So even though you have, Moody's out there saying they're a little bit more concerned about U.S. credit risk, and, you've got additions to the deficit with the stimulus coming out of Washington, you're not necessarily seeing the answer to concern in Europe being flight to safety here in the U.S.?
Well, I mean, I think that the U.S. has U.S. Treasuries would be a flight to safety instrument if things were to go wrong, for sure. More so than I think Germany will be, and I think that's what one of the core reasons are, that that we like the U.S. over Germany in that sense, is that if there is a flight to quality bid, it'll probably mostly take place in U.S. Treasuries more so than in Europe.
So what are you listening for out of this two-day meeting from the Fed? It's the last one of 2010. Anything of significance?
Right. Well, what we at Morgan Stanley are telling clients is that we expect the Fed to acknowledge that there's been some improvement in the economic data. They may even go so far as to say that there's going to be some better data coming out into 2011, but we're still a long way away. So I think that they're going to temper their upbeat comments in terms of improvement with some just a healthy dose of reality that we're only at the beginning stages of a recovery. We've just potentially gotten this fiscal stimulus package. So far, the data started to turn well, but we need to see several data points in a row before we actually start to really do a victory lap, I guess.
All right, Jim Caron, thanks very much for making time for us today.